All right, guys. Good afternoon. Futures Brizio here. It is 1:20 p.m. on Thursday, June 19th. Hope everybody's having a great day. And as always, make sure you smash that like button, subscribe to the channel before we get started. I'm using different screen recording software today, so we'll see how this goes. I might end up be talking to nobody here. So, like I said, we'll just jump right in. It is a holiday here, federal holiday in the U.S. today. It's Juneteenth. So while some of the markets are open, other ones are closed, and even the ones that are open have very low volume. So I haven't placed any new trades today. I won't be. I do have one or two open from yesterday, I guess. But like I said, nothing new today. Like I said, some of the markets are open, some are closed. But even the ones that are open, the volume is going to be very low. So it's a good day just to take a break from the markets or do some analysis, back testing, and just stay out of any new trades today would be my advice. Market will be open normal hours tomorrow, although a Friday after a Thursday holiday in the summer. I don't expect volume will be too high tomorrow either, but certainly will be better than today. Okay, so this is going to be a little bit different. And again, I always try to bring you guys some different strategies and things to think about based on whether you like to swing trade or day trade or use indicators or not use indicators or whatever your trading style is, depending on what you like to do and how much time you have and, et cetera, et cetera. So, what I'm going to talk about here is a little bit conventional, and then there's an unconventional part to this too. All right. So on the screen we have Heiken Ashi candles again, and again you don't have to use Heiken Ashi candles. You can use regular candlesticks certainly. Again, I like using Heiken Ashi because they kind of smooth out price action a little bit better than the candlesticks. But again, as I've said in other videos, they do have drawbacks in terms of not showing you the actual open and closing prices, so you do have to be a little bit cautious with them, especially around major areas on your chart where there's major support or resistance, or especially as if you approach a take profit area. If that take profit area is sitting in an area where there's also a lot of potential support or resistance, it's at a level where price might turn or have some trouble getting through there. You can have a reversal or a pullback on the price, before your Heiken Ashi candles show it. So that's a potential risk, especially the higher up in time frames you are. Okay, so I'm not going to get into all that. Heiken Ashis have a lot of great aspects, but like I said, the main drawback to them is they do not show you actual open and closing prices of a candlestick, because they basically are taking an average of the last couple. But that averaging effect also helps smooth out some of the noise and lets you see trends better and pullback areas better, but that's the one disadvantage. So anyway, so these are Heiken Ashi candles. I am on a 2-hour time frame, okay, because the kind of the unconventional part of this, well, even the conventional part of this, this is a nice in-between time frames. I wouldn't call this a day trading time frame. It's kind of in between a day trade and a swing trade time frame. I mean, I consider like a 1-hour chart or lower to be maybe like a 15-minute to an hourly chart to be a day trade. And then usually you'd say like 4 hours is like your swing trading time frame. This is a 2-hour, so call it what you want. It's an in-between. You may or may not hold these trades. Beyond that, I think if you do the unconventional part of this, which I'm going to talk about, then that maybe lend itself more towards day trading. If you're doing the conventional part of this, it's probably lend yourself more towards, swing trading, where you're going to hold it in the direction of the trend. All right. So for indicator, the only thing down here is a CCI set at a period of 21. So I know you can't see way over to the extreme left edge of my screen, but I'll bring up the settings here. Again, this is MetaTrader 5. It's a standard indicator in any platform, but you can see I have it set at 21, and I have it set to typical price. They give you all these options. Most people use close. You certainly can use close. You can play around with these if you're using MetaTrader, or I think, well, I know that in TradingView there's even more. There's like 15 different, how they apply it in TradingView, which is kind of crazy. But I don't think you need all that. So if you're using MetaTrader 4 or 5, these are the options you'll get. I think you get these in MetaTrader 4 too, but certainly in 5. And again, most people like to use close. I wouldn't use open, high, or low. So it's either close or one of these three: median price, typical price, or weighted close. And it shows you how they calculate those. So median price is high plus high, low divided by 2. And that's how they figure it of the last 21 candles. So in this case, it's 21 period. So it takes the last 21, it takes the high and the low of those last 21, divides it by 2. That's basically what that means. But anyway, so I'm using typical price. You can play around with it. That's not really the critical aspect. I think the length is more important. And in this case, I found 21 seems to be pretty good. I think 14, which is the default setting, is too short. It's going to generate more false signals. So I think 21 slows it down enough where you may still potentially miss a signal or get a late signal. But especially, again, on the unconventional part of this I'm going to discuss, I think 21 is good. Okay, so we'll just leave it with 21, typical price. Okay, so basically here on the 2-hour chart, if we look at this particular asset, this happens to be 10-year yields, but it doesn't matter. We'll look at a couple of different ones. And I'm not going to beat a dead horse on this because it's pretty much the same across any chart. So you, of course, can use this for trend trading and resumption. So obviously, we're in a downtrend here. You can see we've been making higher lows, lower highs and lower lows here. If we just look like here and here and here and here, with this latest swing point being like right here, okay? And assuming that we're going to continue this downtrend, you can see the CCI indicator went back above the zero line. And I've talked about zero line crosses in my last couple of videos. So in that's actually what we're still using. We're not using any overbought or oversold in the CCI, which is why I don't have the overbought and oversold levels drawn on here. Only the zero line, which is this white dotted line here. Okay, and so for trend continuation, very simple. If we're looking at rejoining the trend on this time frame, then we would wait for the CCI to close. In this case, we're looking for sells back below the zero line, which would be just about where it is right now. Okay, so we just drop a vertical line on there. So your entry would have been like back here. We can zoom in a tad bit so it's a little easier to see. So on this candle right here would have been your entry on this time frame, and you could still be in this trade now. You'd have your stop probably sitting above these swing highs. Give it enough breathing room. Position your trade accordingly. This is a 2-hour chart, so it's not going to be a huge stop loss, but position accordingly. So I would say a stop loss somewhere somewhere above this high right here, which is pretty much the same as this one. Give it a couple of ticks above that. Okay, so that's just conventional trading. Okay, and so I'm not going to beat a dead horse. You can see all the areas where you could have entered these trades in the direction of the downtrend. We had another entry right here. We had one right here. This one here, it would have been okay for a while. You can see price did pull back. You probably would have gone into drawdown if you had held this, but depending on your stop loss, that's fine. You would have gone into some drawdown while price pulled back to here, and then we had this huge move down. But either way, in terms of trend direction, these are all valid signals, okay? So again, having the CCI set at 21 is going to really slow it down so that, you'll see these signals, okay? And the Heiken Ashi candles obviously smooth things out a little bit, okay? So that's simple trend following, using market structure and using just what is the trend doing right now on this time frame. Use the 2-hour chart. If you want to peak up higher at the 4-hour, you can, but I don't think you really need to. And then, you know, your take profit levels should be set on a shorter time frame. So, but I'm not going to dwell too much on the conventional way because, again, this is simple trend following using the indicator to re-enter in the direction of the trend that you can see clearly is in a downtrend here as you zoom out. Okay? What I want to talk about is kind of in the unconventional method here. All right, and this is going to be maybe a little controversial, but if you do it right, it's not terrible with some parameters, and that is trading counter trend against the trend using the zero line cross the other way. Now, I just said that we're basically in a downtrend here, but what about this trade right here? You can see the CCI come back through the zero line. Let me draw an arrow here so you can see it. Right here. Okay, we have the CCI breaks through the zero line down at the bottom here. If we look at the chart, that's somewhere around this candle right here. That's about where it broke through. All right, on this candle. Again, it's 21 period, so it is a little late. Yeah, but it's basically that candle. Okay, so how about trading against the trend on well, I don't want to say any, but on most CCI zero line crosses, even if against the trend. Now, here's the caveat. If you're going to trade against the trend, you need to have a reasonable profit target. And I would strongly suggest, again, going down to like a 10 to 15 minute chart and setting your take profit and your stop loss accordingly. Okay? So let's say we took a trade at that candle. Let's just mark that off. And we went long there. Let me move this over. Okay, there's our entry. We go down to the 15 minute. And let's find that area. So here it is right here. So we would have gone long somewhere right in here. Okay. And you can see that price, you know, did go up, did pull back here, went up again. So basically, from this entry and theoretically all the way to here is a trade. This is a 15-minute chart, so this is not a bad trade. Okay, it is counter trend. Okay, so where would I put my stop loss in this case? Well, I would say, you know, I would be looking to put my stop loss here on the 15-minute chart. Let me move this line out of the way. Either here or even lower down here, but at minimum here, which is where this obvious pullback was on this time frame that led to this high. So I would probably just drop my stop loss right here and let this ride out. Now, in terms of profit target, obviously this right here is the peak of this pullback because ultimately the price did go back down again. So this is the peak. Would you have gotten all this? I don't know. In real time, I don't know. It depends on what your mood or your risk appetite is because you can see we had this pullback. I'm just being realistic. In real time, yes, price was going up, great, great, great. And then you start to see this, and you're like, oh boy, here comes the downtrend starting over again. Price tried to rally out of here, came down again. It failed. So if you were still in the trade at this point, this would be a good sign because it failed to break lower on this pullback, came back down. It failed to break below this low, and then it did push up one more time. So but if we just look at this area, okay, well, maybe, you know, you say, okay, well, I'm going to get out when the CCI crosses back through the zero line to the downside on this particular trade. Okay, so that would be, you can see the zero line cross. Can't draw this through the zero line cross happened on this time frame right here. Okay, there's the zero line cross on the 21. And in realistic terms, that would be right about here. Okay, so it crosses back to the zero line, then that would be it. You would exit the trade then, and your profit would have been from about here to here. Okay, which is probably about, let's see, let's say that's 33 points to the upside. So that's actually a negative risk to reward ratio because it's about a 46-point stop loss and a 33-point take profit level. So this is what I'm saying is you got to be very careful. So it's because it's a negative risk to reward ratio because you're trading against the trend. Now, one thing that you could do is you could shorten the CCI on this time frame, or you could drop to a lower time frame. So if you don't want to do that. So just for giggles, let's change this to a 7-period CCI. Okay, so now as price is going up here, all right, your exit actually would have been right here because you can see the 7-period CCI crosses back through the 0 line right here. Now, ultimately, you would have left a little profit on the table because price did go up. So you would have left the difference between here and here, which is 20 points between this high and this break and here, okay, which actually shortens your which gives you even a worse risk to reward ratio, but it also would have gotten you out still with a profit though. All right, so that's what I'm saying. Like, these are not going to be long-term trades. Actually, this would have been profitable. Actually, I take that back because it would have been a little bit better than 1-to-1. If you got in here, stop loss is sitting here, that's 45 points. And then from here, if you got out when this crossed over, it's about 49 points. So it's about a 1-to-1. And you know, on a counter trend trade, that's not bad. What else could you do? Well, maybe you leave the CCI at 21, but you use a shorter time frame. So let's change it back to 21, and let's just mark this area off so I don't lose it. Just mark off this whole area, and we're going to go to a 5-minute time frame. I got to turn off the scroll so we can get back here. Okay, on the 5-minute time frame, your CCI crossover on the 21 happens right here, okay, which is actually pretty good. All right, it would have happened right there. So if you got out there on the close of that candle, and again, let's remember where our entry was. Our entry was, I think, what did we say, right here, I believe. All right, so let's go back to the 5 now. This was our original entry. All right, and now you're talking about a 53-point profit potential versus a 45 point, so a little better than 1-to-1. All right, and that's it. And then you'd be out at that point, and then actually at this point you might be you go back to your 2-hour chart, and you would actually wait for price to close back below and re-enter the direction of the trend. So it's a counter trend trade strategy. And let me clean this chart and get all this garbage off here. All right. It's a counter trend trade strategy. Okay. Here's another one back here. Okay. Now at this point, let's assume we still thought we were in a downtrend. Okay. Price trades through the 0 line because we were putting in lower highs, potential lower high right here. Okay. But here, price breaks above the 21 period right here. Let's drop a line on there. There's our break. This one would have been sweet, right? So here's our entry, right? Crosses through the 0 line on the 2-hour chart. We have a blue candle. Now we drop to our shorter time frame. We'll go back to the 15. Here's that entry right here. In this case, I would have put my stop probably. This is probably too close. Now, you may have gotten knocked out on this little pullback if you had it here. Because, again, this is a 15-minute chart, I would have given it a little more breathing room. Maybe put your stop down here or even down here. Obviously, it makes your risk-to-reward ratio lower. But, if we turn on the actual candlesticks, you actually would have been okay. Even if you had your stop like sitting a couple of ticks below this low, you would have been okay. So let's say you did. Let's say you had your stop sitting like right here. Okay, you would have been okay. All right, so, and then you'd have a really good risk through. So again, your entry point was here. You would have gone into a little bit of drawdown. Again, this is a short time frame, so this is no big deal. Okay, and then price shoots up. All right, on this time frame, your exit would have been right here. Okay. right about at this candle, which would have been about 87 points of profit versus 31 points of risk. So almost 3 to 1. Okay. And you will get some like this. Now, the first one I showed you, it was barely a 1 to 1, but this one's a 3 to 1 because it was such a big pullback. Okay. So this is what I'm saying. Now, again, you could fine tune this again because our exit point on this, on the 15-minute time frame, like I just said, would have been right there. I don't think you really want to get too much better on the 5, but if we go to the 5-minute, got to go find that again. Oh, just passed it. On the 5-minute, your exit would have been a little sooner back here. Okay, but that's really about the same price. It's slightly better, so you wouldn't really have a much better exit here using the 21 or using the 5-minute chart. So again, for the take profit levels or where you want to exit the trade, I would recommend either keep the 21 period and just use the 5-minute chart and wait for that crossover to happen back in the direction of the larger trend on the 5-minute, or maybe have a second CCI on the 15-minute chart set to a period of 8. Have it only showing on the 15-minute, which you can do very easily in any trading platform. You can set it to show on only particular time frames, so that on all the other time frames the 21 is showing, but on the 15 it shows an 8 period, and then you can just use that for your exit. I don't think there's much. You're just playing around with the calculation. So an 8 period on the 21 is probably going to give you a similar view as keeping the 21 period on the 5-minute. So just to your preference. Okay? But that's basically the strategy, guys. I don't want to overcomplicate it. It's essentially using, again, the 2-hour chart. And I would recommend the 2-hour chart. It's a good in-between. If you do it on a 4-hour, you can do it on a higher chart. You can use the 3-hour. Some assets might be better suited for the 3-hour, depending on their volatility. Because, again, you don't want to take everyone. Now, some of these are not going to work out. Some of these you're going to get that push up, like in this case, counter trend in the direction opposite, and it's only going to go a tiny little way, and then it's going to go back. So you may end up with a loss. You may end up with or a less than a 1-to-1 risk to reward ratio at the end. But even if it is profitable, okay, great. Obviously, you want minimum 1-to-1 risk to reward ratios, minimum. But in some cases, you may not end up with that. But you won't know until you get the reversal back, in the direction of the trend. So you kind of have to just wait and see. And like I said, sometimes it's not going to work. You're going to get stopped out. Or if your stop loss is too tight on the shorter time frame, you got to give these trades a little bit of breathing room, which again could adversely affect your risk to reward ratio. But certainly, I think a lot of these are good as long as you have your CCI set properly, and you're using the right time frame. Okay, so that's like 10-year yields. I mean, you could do that. This is NASDAQ, so this is the September NASDAQ NQ, and you could do the same thing here, right? We were going up. This is an uptrend going on right here, all right? Where do we have negative? I'm just going to pick one here. So here's one that's going to be pretty small, but it is there. Now, again, you have to use your own discretion whether you want to take these. I'm not suggesting you do. I'm just suggesting that this is another potential way to do this. So I'm going to look at one here now that's very small. So we were clearly in an uptrend, but we had a crossover to the downside here on the 2-hour. So let's just mark this one off so I don't lose it on the chart. Let's just zoom in here. This is May 13th. So now we're going to drop to M15. We'll go back to May 13th. We'll find that box I just drew. Okay, here it is. So this was our entry. Okay, what did price do? Well, it did go down. If we got in here, all right, that is about 80 ticks on NASDAQ. It's not actually, even though it's not a lot, it's really not that bad of a trade. Let's see on this time frame where we cross back through the zero line. Would have been right here. Okay, would have been right here, basically at this first blue candle. So your profit would have been from here to here. You'd have your stop loss sitting up here. So that's probably a little better than 1 to 1. Okay, so from here back to this high is about 86 ticks. From here to this low is, so this is a -1 too. We got 70, but this is a small one. So as I said, guys, this is unconventional. I would not recommend new traders do this, but if you're experienced and you just want to like be able to scalp out a little bit of these, it's not bad. Okay, so if we drop to the 5-minute now and we look at it for our, again, here was our entry and our exit would have been, again, right here. Okay, because that's when the CCI crossed back through, okay, on this time frame. So it's probably about the same gain. This is actually a little worse. You actually would have been better off on the 15-minute here because just how responsive. Oh, you know what? We're still using a 20. That's why we have to change this back to 21. Darn it. Okay, so on this time frame, we're on the 5-minute again. Actually, you know what? Let's start over then because I want to be honest with this. I don't know why that was showing 8. Okay, so let's look at this area again. So we had this area. Okay, so actually we would not have had a crossover here because you can see now I changed it back to 21. There was no crossover on the CCI, so this would not have been a signal. So let's see if we can find one in this uptrend. Okay, well, how about this one right here? All right. There was our entry there. Okay, this was back on May 9th. All right. Again, this is going to be a really small one again. And now we'll drop to the 5-minute chart, May 9th, because we're going to leave the CCI for now at 21 and just use the smaller time frame. This is why I don't like MetaTrader in this respect. Because when you change time frames, it doesn't like keep you in the same spot on the chart. Okay, so here was our entry up here. Okay, and then we had price break back through right here. Okay, so our exit would have been right there. Okay, our stop loss would have been sitting right up above here. Okay, which actually this is a pretty tight stop. It's about a 34 tick stop for potentially a 101 tick gain. So this is 3 to 1 risk to reward ratio. Okay, and then of course on the higher time frame you could have rejoined the trend, the uptrend. Right here you can see price cross back through on the 2-hour chart, cross back through to the upside. We don't need to go to a shorter time frame really for this because we're in an uptrend. I mean, you can go to the short time frame to set your take profit, but I wouldn't stress too much about it because we're in an uptrend here. Okay, so this is the main trend re-entry right here, which it clearly gave you a nice signal on. Okay, but so I'm just saying within these larger trends, these pullback areas are potential profit areas. Again, it's not going to work every time. Sometimes your risk to reward ratios are going to be really small, maybe 1 to 1. Maybe even a tad bit less depending on your stop. Maybe you keep your stop loss tight. So you know what? If it's not at least 1 to 1, either don't take the trade, go down to the 5-minute. Well, actually, you won't know because you won't know ultimately how far it pulls back. So you really can't decide that prior to getting into the trade. But, you know, either keep your stop loss really tight, you know, at the shorter time frame swing. And then, you know, if you get knocked out, you get knocked out, so be it. Or give it a little bit more breathing room. That will reduce your risk to reward ratio, but at least you'll make something on the trade and then you'll be able to get out and then hopefully rejoin the larger trend and, you know, get a much bigger trade. Okay, so that's the unconventional part of it, guys, which is basically counter trend trading. Using the CCI, again, 2-hour time frame, 21 period CCI, waiting for it to cross through the 0 line in the opposite direction of the trend, wait for that candle to close below the, wait for that candle to close and wait for the CCI to close below that 0 line. When you see that, just go right in at market, go down to your shorter time frame, either the 5 or the 15, set a reasonable stop loss either at a nearby swing or maybe 2 swings away if you want to give it more breathing room. But at least 1 swing away. Give it a couple of extra ticks, above or below that. And then as soon as CCI crosses back through on that short time frame, then you be out. Now you might be able to, if you get a really excellent deep pullback, that can turn into a really excellent trade, even though it's counter trend. But, be willing to only, keep the trade for a short period of time. It might only be for a day, might be for a couple of hours, but I would say just eyeballing those ones we looked at. I would say they're a minimum of a couple of hours that you'd be in them, and maybe longer, if it's a really deep pullback. And maybe at some point you catch a reversal trade, where price just reverses off that level and it never really comes back. It just completely goes the opposite way. And then, that what you thought was going to be a little tiny trade turns into a big one. So, all right. So I don't want to be a dead horse, guys. You can take this and look at any chart. You could do this on Forex. I did look at a couple of Forex majors. I don't know if I would do it on minor pairs or exotics because they're too volatile and you'll have a lot of whipsawing on the CCI even with this setting. On the 2 hour. But if you look at your majors, outside of big news periods, but that's the same for futures, obviously during, volatile news events, you're going to get whipsawing, but outside of that, just regular price action, I would say stick to Forex majors. But I did test it on Aussie dollar, Euro dollar, dollar yen, stuff like that. I did test it on Euro Aussie, which is one of the crosses I look at. And that it actually worked okay there, but I would, obviously if you want to limit your trading to just certain assets, great, pick a couple and that's it. But if you, depending what you do like to trade, I would say this probably would work on anything. You just have to play around with what the best time frame is to look at, whether it's a 2 hour or 3 hour, and then, what time frame to go down to set, take profit levels, etc. and stop loss levels, okay? But I would stick to the 21 CCI, and just like I said, just you might need to tweak the time frame a little bit, find what works best. It might not be the same for every pair or every market, and that's where you have to experiment. I don't know what you trade, so you have to play around with it. But this allows you to not only swing trade signals back in the direction of the larger trend doing this, but it allows you to participate in pullback areas too, and take some profit out of the market even on corrections. Here's one right here. I'm not going to go through the whole thing, but this is one right here. I mean, look at this pullback right here. Here's the crossover on the 2 hour chart. If you got this whole thing, that's 306 points of NASDAQ, all right? If you caught this whole thing with obviously a stop loss with a, what is that, 180, it's so small, 180 points. So better than, basically a 2-to-1, maybe a little better than 2-to-1 risk to reward from here to this, if you put your stop above here. And this is a nice little pullback, all right? And a 2-to-1 risk to reward ratio, that's good on any day. But, on a counter trend trade, it's awesome, So, and you could have definitely taken advantage of that. And again, then just use the shorter time frame, like the 5 minute, to kind of plan your exit, which is hopefully will be down over in here somewhere. Okay. So, so that's it, guys. I'm going to leave it there. I don't want to beat a dead horse. Again, I don't necessarily recommend this for brand new traders, but for those of you that are experienced and can look at price action and know when it just doesn't look right, maybe some of these you skip, and take the ones that are more obvious where maybe that first candle in the counter trend direction is really strong and in this case bearish and not just like a little tiny double wick doji, suggesting that maybe that selling pressure is not very good. But if it's in the case of a Heiken Ashi candle, when you get these flat top candles like this, like in a bear candle, if there's no wick on top, that suggests pretty pretty bearish price action, whereas you have one like this one, you know, where you get a wick on the top, maybe that's not so good, you know. So that's the kind of things you have to work out. And whether you use regular candlesticks, then that's fine too. All right. But so basically, you know, using the 2 hour with the CCI for obviously trend re-entry signals, it definitely will give you that. That goes without saying. Covered that right at the beginning. But also the opportunity to trade against the trend using that same zero line cross, and then just using a shorter time frame to try to squeeze as much as you can out of that while minimizing your risk and trying to maximize that risk to reward ratio the best you can. But understanding in some cases, because you're trading against the trend, you are going to get smaller risk to reward ratios. Might only be 1-to-1. You saw we had one that was actually less than that. As it turned out, you won't know that until the trade's over. But you know, you can still get some profit out of that. And, you know, expect a few losers too, because you're trading against the trend. You have to expect to take losses, maybe a higher loss rate than you would trading in the direction of the trend. But just make sure, you know, you position accordingly. Don't over leverage on any one position, and, you know, place a reasonable stop loss. So, all right, so I'll leave it there, guys. Questions, comments, leave them down below. Smash the like button, subscribe to the channel, and I hope that was helpful. I will talk to you guys really soon. Talk to you in the next video, and I don't know if I'll take a look tomorrow. Like I said, the markets will be open. And, you know, so we'll go from there, and maybe we'll see if we get any of these type of trades tomorrow. All right, guys, take care. Have a great day. Talk to you soon.